I'll turn, yeah, Sky? No, Jessica?
When are the homeworks for 16 and 17 due? Are they due at the same time? Or?
No, chapter 16 is due here.
December
Let's just-
1st.
Yeah, let me just take a look here. So chapter 16 is due December, chapter 17 is due the 24th, which is this coming Sunday. And then chapter 16 is due the following Sunday. Okay? And then the third test is due the following Monday.
So we're not doing the Mondays anymore?
Okay,
We can change all of those.
let's do change all of those, yeah, maybe, what if I did? We can sure do that. Well, we can't do it with 16 because it's the day of the test.
Yeah, that's
Okay, you want to make 17 due the Monday? I can do that. You can do that? All right, so listen, chapter 17 will be due the 25th. And that way, it'll be due Monday. Okay, sure. All right, you guys doing good and everything? All right. All right, so 15, actually, so we only got 2 chapters left, 17 and 16, right? So 17, let's move it to November 25th, which is just a Monday. And then 16 will stay where it is, December 1st. And the reason is because December 2nd is about the test. That's true. Okay. All right, you guys doing good and everything? All right. So, let's go on to chapter 16. So now chapter 16, so remember what, getting back on now. How you doing, Jonathan? All this is, yeah, a little tangential. All right, everybody's doing good. Got the dates with that?
Sinking in.
Sinking in, all right, sounds good. Okay, all right. Antonio, you've been quiet back there. You doing good? Okay, that sounds good. All right. Don't have to worry about Ted. He'll let us know. Michael, you doing good? Okay.
Okay.
All right, just checking in. Scott, how are you doing? All right. Okay. Sounds good. All right. So here's the deal. Remember when, let me back up a little bit. You guys remember when we had the Enron debacle, right? So what happened with the Enron debacle is the fact that the income statement looked good, balance sheet looked good, everything looked good, and a whole bunch of people got fooled. Okay? So, what happened, a whole bunch of people got fooled. How, in retrospect, how could people have told whether that was a good investment or not? Okay? Well, the answer is if they look at the statement of cash flows. And it's simply because what happened there is the fact that there was a whole bunch of profit. But if you looked at the statement of cash flows, that profit hadn't been turned into cash. And if you got a lot of profit and no cash, something's amiss. And the point of the matter is, the income statement is kind of fun to look at, making a profit, getting rich. The cash flows is boring. And nobody gave it the due it was really worth. And this instrument was there, it was published, and nobody really looked at it. Okay? Just because it doesn't have sex appeal. All right? It really doesn't. Okay?
But also wasn't it, they didn't want anybody to look at that because then they would have known what they were doing.
Well, by the way, it also was convoluted, because I thought maybe I would use that as an example when we got to this chapter. But when I looked it up, and it's, it still was hard to read, so it wasn't, I couldn't use it as a good example. But if that's where you would have been able to tell, would have been looking at that statement of cash flows. And again, what it said, and again, and the reason you would have is because you had all this profit in the income statement, but it didn't turn into cash. And if it doesn't turn into cash, something's wrong. Okay? There you go.
Did it show as like an owner's equity or?
Well, first, no, with the statement of cash flows, let me get into that right now. It will just show you how the cash is coming in and out of the business. So what the statement of cash flow does is it records how, it'll demonstrate, report how cash is coming in and out of the business. Okay? So let's just kind of get into this chapter 16. I'm going to turn this around here. Okay. You know, these 2.5-hour classes are just too long, aren't they?
Mm-hmm.
They really are. People just get,
Exhausted.
Exhausted, yeah. Your brain is full.
Mhm.
It's time to go party.
About that,
I don't know about that. All right, let me do
More like
this.
sleep.
Maybe the place to start with this would be to show you what we're actually talking about. Let's start there. Here's what one looks like. And once we show you what one looks like, then we'll go on to explain what it is and all the categories. So here's what you want to do. This, so I'm going to turn on the light so this is easier to read. So basically, here's the way it works. This is what one looks like. Okay. So here's what it is it's the statement of cash flows. Now, cash flow from operating activities. So here's the net cash provided for operating activities. So this is whatever business you're in. Cash received from customers, cash paid for merchandise, because that's money out. Cash paid for wages, money out. Cash paid for interest, money out. Cash paid for taxes, money out. So we got one money in, four monies out. The net cash flow from operating activities is $20,000. So whatever business these people are in, whatever business Genesis is in, the operations supply $20,000 in cash. Okay? Now, cash flow from investing activities. Now, investing activities, essentially, you're buying and selling a long-term asset. If you buy a long-term asset, cash paid for purchase, it's money out. If you sell sale applied asset, you sell applied asset, money in. So you sold something worth $12,000, you bought something worth $10,000, so there's a net inflow of cash from investing activities of $2,000. Okay? Cash flow from financing activities. Now this is selling stock or borrowing money. Okay? So cash received from issuing stock, $15,000. Cash paid to retire notes. Okay? So here you have debt and investment, return on investment. So here you have cash paid for dividends, money out. So here's selling stock, retiring debt, paying dividends, a net decrease in cash of $17,000. So $20,000 cash in from operating activities, $2,000 cash in from investing activities, $17,000 cash out from financing activities, a net increase in cash of $5,000. And the cash at the beginning of the year was 12, the cash at the end of the year was 7. So if you look at last year's balance sheet, you looked under cash, it will report $12,000. You look at this year's balance sheet, you look across from cash, it's a 17,000, and that meant there was an increase of 5,000, and this is where that increase came about. Okay, so this is the statement of cash flows. And the object is to just report how cash is coming in and out of the business. Okay, and this is what one looks like. And it has 3 sections. Okay. And by way of introduction, there'll also be a 4th section down here. So when you have non-cash financing investing activities, it's also disclosed in this item. So suppose what they've done is they issued a note in return for a building. Well, that meant they would have acquired an investing activity, a building, and they would have incurred debt. There was no cash, so it's disclosed down at the bottom as non-cash investing and financing activities, because at some point in time, it'll be a cash concern. Okay? All right, so that's what one looks like. So let's kind of back up just a little bit. So what we're doing with this thing is we're answering some questions, such as, how does the company obtain its cash? Okay. So with the statement of cash flows, it answers questions like this. So this is chapter 16, statement of cash flows. Okay, and it says, answer the questions, the purpose, how does a business obtain its cash? Okay. Where does it spend its cash? Okay. And what explains the cash, the difference in the cash balance? Okay, and of course, so that's basically what it does, okay? And again, the reason it works this way is don't forget, profit is independent of cash. So you go to the income statement to see what the profit was, right? But that doesn't report the cash. And so what this does, saying the same thing from a different perspective, is what this does, this will convert the accrual basis to the cash basis, is another thing that it does. Okay? All right. Okay. All right. And of course, this is important because how did the business fund its operations? Okay. Do they have sufficient cash? Okay. Did they borrow money? Okay. Did they pay dividends? Okay. All right. Okay. All right. Now, there's three categories here, as we went over before. What you do is you have operating activities. So there's three categories. You have operating activities. You have investing activities. And you have financing activities. So, as we mentioned for operating activities, okay, essentially you have revenue, you have expense, you have current assets, and liabilities. Okay, so in operating activities, what we're talking about here is we're talking about revenue and expenses, right? And we're talking about current assets and current liabilities. Now, Ted, I see a quizzical look. Let me answer that quizzical look. You're good? Well, listen, let me anticipate this.
Reading.
Reading, okay. Oh, you're reading. Current assets, oh, it's too small.
My eyes are just,
Or it's too long a class. We need these like, well, yeah, it is, it's too long a class. Isn't that Friday nice though? No, seriously.
it really is.
There's a lot to be said. Okay, a little bit of suffering pays off. All right, here's the deal. Don't forget, current assets and current liabilities support operations. So what happens here is you make money, you send an accounts receivable, you're waiting for your cash. So that's how you support the current operations. You buy supplies and you want to pay back 30 days. So that's an accounts payable. So when we talk about operating activities, we talk about revenues, expenses, current assets, and liabilities. Okay? When we talk about investing activities, what we're talking about,
Purchasing and selling stocks.
yeah, we're talking about purchasing and selling long-term assets. Okay? So we're talking about buying and selling long-term assets. Okay? All right. And financing activities, we're talking about liabilities and owner's equity. Okay? All right. Now, so here's the way this works is, if you lend money, right? And it'll be like you lend money, that's an investing activity. If you borrow money, that's a financing activity. Okay? If you pay a dividend, that's a financing activity, right? However, if you receive a dividend, that's an operating activity because it's short term. Okay? So if you pay a dividend, that's an owner's equity concern, shows up as a financing activity. But if you receive a dividend, that'll be from one of your investments, but it's current. And then paying and receiving interest, both are operating activities. Okay, even though here's the debt, this is the principal shows up here, the interest shows up here. And just because the interest is an income, the dividend and the interest received and interest paid, all of those are income statement concerns. Therefore, they show up as an operating activity. Okay, does that make sense? Okay. Now. Okay. All right. So, let's do this. Now, what's important to realize here is the fact that there are two kinds of statement of cash flows. Okay, there's the direct and the indirect. Now, this is an example of the direct, the one I have on the board here. Let me turn that camera around. Okay, so this is an example of the direct. And let me put this up here. Here's an example of the indirect. Now, what happens here, there's two ways of doing a statement of cash flows. One is the direct, one is the indirect. Now, the only difference is how you calculate the cash flow from operating activities. The investing activities and the financing activities are the same for either method. The only thing that's different is how you calculate the cash flow from operating activities, right? Now, the advocates of the direct method, which is this one, say it makes sense, it's easy to read. Okay? Here's the indirect. Now what the indirect does is the indirect, so the direct we went through. Here's cash received from customers, cash paid for merchandise versus money out, cash paid for wages money out, cash paid for interest money out, cash paid for taxes money out. So the money in minus the money out, the net change is $20,000 money in, cash in. Does that make sense? You ended up with the same dollar amount using the indirect method, but what you did with the indirect method is you started out with the net income. You found that in the income statement, right? And then you converted the net income on the accrual basis to the actual cash basis. And what you did in that conversion, so here we have accounts receivable negative $20,000. So what happens there is if you make a sale, right, it's revenue on the income statement, on the accrual basis, is that right? But if the customer is an accounts receivable, they're going to send you the money. And therefore, you subtract an increase in accounts receivable because it was a sale, it was included as part of this net income, but because you didn't receive any cash, it's not a cash. So in this case, those accounts receivables are taken out because it showed up as part of this $38,000, but you didn't receive any cash. Does that make sense? So let me start out with that one that's kind of easy to see. How you doing back there? Does that make sense?
Yeah, because it's an asset, right? It's an asset that hasn't turned liquid yet.
That's true, but it's more the idea that this net income is calculated on the accrual basis.
Okay.
And the accrual basis doesn't, okay. However, when you convert that to the cash basis, you have to subtract out those sales for which you have not received cash.
Okay.
We call that accounts receivable. Okay? And so what we're doing is we're taking out, that's why we're subtracting it here, because it's a sale, but no cash. So it was included as part of net income legitimately, but now there's no cash, so we take the cash out, okay? So, what I'm doing now is I'm introducing these things, right? Now later on, as you guys know from studying accounting, it gets infinitely more complex and hair splitting, okay? Well, we'll get into that in a minute, and much of this is a matter of practice, so we'll do practice as we go along. So to kind of sum up, in every case, there's three parts to the statement of cash flows, right? You got the cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. That reports the net change in cash, add that to the end of what you had last year, and it should be the same as what you have this year. Does that make sense? So last year's balance sheet reported 12,000, and then that became the beginning. And then this year's balance sheet reports 17. That difference of 5 is explained with all this. Does that make sense? Now there's two ways to do a statement of cash flows. There's the direct and the indirect. This is what the direct looks like, this is what the indirect looks like. They'll both give you the same dollar amount. The advocates of the direct say it's easy, it's straight, it's easy to understand, it's straightforward, it's more meaningful, right? Now, if you guys had to guess, one of these is used by 1% of the companies in the United States, and one is used by 99% of the companies. Which do you think is used by 99% of the companies?
Direct.
The indirect.
To make it harder to scrutinize.
Well, hey, listen, when I was at the American Accounting Association conference a couple of years ago, and these are the top, you know, most everybody in there, well, I would guess well over half the people in there are PhD in accounting, right? And they were saying, you know, when I look at this, the only reason we're using this indirect method is it just means the accountants have more job security and we can make more money. There's no other reason why we should do this. And then they went on to say, and if we were honest, we'd change, but nobody's going to do it because we have all our systems are set up to calculate it this way. It's prohibitively expensive and we'd be out of a job. Let's face it, even though it's a crappy way of doing it, we're sticking with it. No, I mean, that was the sort of talk, and they weren't kidding, okay? Yeah.
Which one's direct and which one's indirect?
This is direct, and we will not be studying it because you guys will never see it.
Okay.
This is the one we'll be studying. And it's the one, and it's used by like 99% of the companies. And that was the talk I heard at the American Accounting Association when they discussed this. Because there is a definite group of people who say, this is the way we should be doing it. If we were, but let's go with the smoke and mirrors. Okay? Just because it, and the thing is, the other thing is, because all the systems are set up to do it this way, it would be horribly expensive to change to another system. It's better, but it's not, doesn't justify that kind of expense. Yeah.
It makes no sense, because I'm looking at over there, like, the loss on the sale of the plant assets, it says $6,000, right? When you look over on the purchase and the cash received and paid and everything over there from plant assets, you've got 12,000 in, 10,000 out.
Okay, a couple things. Number one, don't forget, investing activity and financing activities will be the same for both.
Okay.
Here's what happens on this thing is, depreciation is easier to see. Let's start there.
Okay.
On the income statement, there was $24,000 worth of depreciation expense. Now, depreciation expense, how did that come about? It was your estimation of how much something wore out. But what with the 24,000 cash? There was no cash. It's only an estimation. So what you're doing to convert this net income
From the income statement.
from on the income statement, right? To convert this on the accrual basis to the cash basis, you add back depreciation expense because it was a legitimate expense on the accrual basis, but there was no cash. There's no check for 24,000. It's merely your estimation of, I hate to say your, I didn't mean to put you in the spot. It sounds accusatory. It's just that, you know, when you have a little story like this, people remember it. So the accountant says, listen, I estimate that our machinery wore out 24,000. And that is an expense on the accrual basis. But there was no check for 24,000. It's merely an estimation. Well, by the way, the same thinking applies to the loss on the sale and the gain on sale, because the loss on the sale of plant assets, again, all that is that means that the cash, when you compare the book value to the cash, they receive 6,000 more cash than the book value. But there's no $6,000 check, it's just the difference between the book value and and of course what it does is it reconciles the depreciation was an estimation. Here they made the actual sale and they reconcile the estimation versus reality.
And that's
But
the-
there's no $6,000 check.
Okay, so I understand that. Why are they not taking depreciation and making it negative, and the loss on the sale of the plant assets?
They're canceling them out. The depreciation is a negative on the income statement. Therefore, they're canceling it out by adding it back in. And the same is true for the loss. The loss was subtracted to get the net income, and now we're adding it back. And the gain, of course, is the mirror image of the loss. All it means is we pay, in this case, they receive $16,000 more cash than the book value. This retirement notes, in this case, the carrying value.
So basically what this statement of cash flows does is it adjusts the net income to take into account the things that impacted it in ways it shouldn't have?
You're pretty close. It converts the accrual to the cash basis.
Okay.
So a depreciation expense is an accrual basis, but it has nothing to do with the cash basis. Because the cash basis, if you spend money, cash out, you receive money, cash in. Depreciation isn't.
Right.
Depreciation is not a cash concern, it's an accrual concern. And so what you're doing is you're converting this accrual to this cash.
Understood. Thank you.
Sure. Yeah.
Which are the 1, 2, and 3 categories?
Categories. Eddie, we'll see you next class. Okay. They're just categories. This is one category of adjustments. This is another category of adjustments. This is the third category of adjustments. Okay. Yeah, Michael?
So all of this information then would be, you'd be working off of another statement? You'd be working
Well,
off
sure.
the income statement and then
Yeah,
pulling this into
sure.
this? Do you have that? So we
Yeah,
can
I
see
got it
it
right
side by
here.
side?
Here's what you do now. Is here, where this came from, here's the income statement. Here's the 38,000 net income, right? Here's the balance sheet. So what happens is, here we have year 1, 2010, year 2, 2011, right? So what it means is accounts receivable increased by 20,000. That's where this 20,000 came from. And so what it means is you have $20,000 worth of sales and no cash for those sales. Therefore, you subtract it. And this is where it came from. Now,
So
by the way,
had those numbers have been the opposite, so if, under your thumb, so had that been 60,000 in 2010, 40,000 in 2011, then that would be added in.
exactly. And the reason is because, now by the way, guys, I know that I'm being kind of, normally my lectures are pretty straightforward, right? I explain something, we practice. This I know is kind of disjointed, but all I'm doing here is I'm just introducing it to you guys. And then when we go back and practice and explain, I think you'll have a lot of hooks to put things on, and I think you'll learn it better. So I do realize this is disjointed, but I think it's a good way to introduce it. In answer to your question, Michael, exactly. Now don't forget, the cash basis, you call it cash when you call it cash when you receive it, not when you make the sale. So if this went from 60 down to 40, it would be the reverse, right? What it means is you receive some cash from the previous year, but you call it as income for the current year because you call it income when you receive it, not when you earn it.
Right.
Because the accrual basis is when you earn it, not when you receive it. Under the cash basis is when you receive it, not when you earn it. Okay? So if this went from 60 down to 40, you call it cash revenue this year because you received the cash this year, even though you earned it in the previous year. Okay? All right, you guys doing good? Okay, now, liabilities work in the opposite direction. So notice, so here we have an increase in accounts receivable. Now let's go down to accounts payable. Here we have a decrease in accounts payable, and we're subtracting that decrease. Now, what this means, so here we have a decrease. So in this case, here's accounts payable. It went from 40 down to 35. Now, why did we subtract that difference when we converted from the accrual to the cash basis?
Because we went down.
Because you paid it. Yeah. What this means is when you went from accounts payable, when it went from 40 to 35, it's the equivalent of the expense because it's when the cash is paid that makes an expense, not when you incur the debt. So in effect, you're paying off some of last year's debt, but it comes out of this year's income statement because it was paid this year. That make sense? Okay. And so, and then we talked about depreciation expense you're going to add back. You're adding back the loss, you're taking out the gain, and it's because these don't involve any cash. Okay? So, by way of introduction then, and this was, Diana, you asked about the 1, 2, and 3? So again, what you do is one category on this thing is when you have, so don't forget, current assets, okay, so long-term assets show up as an investing activity, right? But current assets show up as an operating activity. So for current assets, when they increase, you deduct it from net income. And accounts receivable is the easiest one to see, but it works the same way with all the other current assets. Current liabilities work in the opposite direction. When they increase, you add it to net income because you have an expense that you have not paid for. Okay? And then you add back the expenses that had no cash involved. So you add back depreciation, amortization, and depletion, all for the same reason, right? And then you add back the losses to reverse, to wipe them out, and you deduct the gains to wipe them out. Okay? And so to kind of sum up this, so what I did is I just introduced you to the statement of cash flows. So to kind of sum up, as far as the statement of cash flows, the purpose is how does a business obtain its cash, where does it spend its cash, what explains the difference in the cash balance from beginning year to the end of the year. It shows how they fund operations, is there sufficient cash, do they borrow money, they pay dividends. There's 3 sections. There's the operating activities, and they involve revenue, expenses, current assets, and current liabilities. Investing activities is buying and selling long-term assets. Financing activities are liabilities and owner's equity issues, right? There's 2 ways to do the statement of cash flows. There's the direct and indirect. The direct is easier to understand. It looks like this. However, it's so infrequently used that we'll be doing the indirect in here only. Now, in both instances, investing activities and finance activities are done the same in both statement of cash flows. What's different is the operating activities. So when it's direct, they actually state where the cash comes in and goes out. On the indirect, you start out with the net income from the income statement and you adjust it to go from the accrual basis to the cash basis. So if you have an increase in accounts receivable, you subtract that difference because you have sales with no cash. You add back your depreciation expense because it's an expense with no cash expenditure. It's only your estimation of how much something wore out. If you have a loss on the sale of plant assets, you add that back. It's because you received an amount of cash that was different from its book value. Does that make sense? In both cases, the cash from operating activities, no matter what method you use, will be the same. All right, so we just introduced it. And so what we'll do is we'll get into the finer points and we'll practice next class. You guys doing good? All right, you have a good day. We'll see you Wednesday.